Welcome to Profiles in Risk. This is your host, Tony Cañas. And today I have with me the co-founders of Juniper Labs, Lance Poole and John Stevenson. And today we're not specifically talking about Juniper because they were already on the show with Nick last fall. I will link that in the show notes. So to learn more about them, check out that episode. And of course, that episode's like 6 months old. InsurTech changes a lot, so check out their website to learn about what's going on today. But what I love about this guys is they're actually insurance people. They actually grew up in the industry. In fact, Lance comes from the actuarial side, and John comes from the underwriting side, even though he's the tech side of the house nowadays. So, guys, thank you for joining me, Lance and John.
Totally.
How are you guys doing today?
Yeah, doing good. Thanks so much, Tony, for having us on.
Totally. Oh, it's my pleasure, and we are recording in late April, and I'm guessing this will go live at very late April, but we are recording in late April during the heart. I mean, we don't know how long it's going to go for, but the heart of the coronavirus mess. And today's episode is specifically about that. You guys wrote a white paper called "Coronavirus and Commercial Insurance," and I found it very interesting. So today's episode is specifically about this white paper and kind of how the coronavirus might affect the industry. I'm curious, what led you to go ahead and do this research?
Yeah, I'll take that one, Tony. We have, by the nature of what we do at Juniper, access to all sorts of interesting, public data. And then we were just hearing from our carrier partners, there's, a lot of that's the topic of conversation was around coronavirus. So we thought, what if we took all this data we have access to, can we draw some insights out of what happened during the 08-09 crisis to have some sense of what might happen through this crisis? I mean, everyone is pretty clear this is as bad as 08-09. It's just like, what order of magnitude? Is it 2 times as bad, 4 times as bad, 10 times as bad? And so that gave us the idea of, let's look at the 08-09 data along with studying past pandemics to think about what are the implications for insurers today.
It's weird because 08-09, so I was in my first job in 08. I was working for a non-publicly traded company, so that was good, and I didn't work in finance, so that was good. But I worked in transportation, and basically the market to transport goods died overnight, right? And I ended up getting downsized a few months later because of that death, and that's how I fell into insurance. So I owe my career insurance to the 08-09 crash, but that crash was a financial crash, right? So now we have, it's so weird because the economy was doing fine. I mean, it had problems, of course.
Right.
And I'm a liberal. In my opinion, it had big problems. Yep. Right. Like in my mind, the stock market is not the real economy. So there were big problems, but unemployment was low, right? Production was high, productivity was high. Like we had a very productive economy, and it's not that like the airlines are a great example, right? It's not that the demand isn't there. The demand is being held down by fear of, right? Like I still have the money to vacation, and I still have the business need to get on a plane and go to conferences, but my clients are working from home. And the conferences are suspended because, right, and with every reason, right? I'm not protesting the fact that everything is closed, but basically it's such a weird situation because, like, the economy is there, it's just shut down in an artificial way to keep to minimize the number of deaths, right? So what did you guys find as because this is not 08, right? Whether it's bigger or smaller than 08, it's not 08. It's not 01. It's not. I'm too young to give you exact years of the prior ones before 01. This is not the 70s oil crisis, right? Like this is not a world war. So we're back to 1919, almost exactly 100 years ago. When the what's it called,
It's Spanish flu. Yeah.
Spanish flu, which actually probably didn't come from Spain, Kansas apparently, right? We're back to, and the world was very different. The economy was very different, right? We're talking an almost agrarian economy back then, and like the industrial part of the economy was completely industrial. It was not at all digital like it is today, right? You couldn't work from home in any way, shape, or form. So anyways, I got going there. Sorry. So yeah, tell me about the white paper. So you told me the why. So let's kind of look at what did you guys find?
Yeah. So a few things that were interesting is that one thing that we'll start with the good news, right? Things that are encouraging. So I think one thing we found is looking at 08, 09. You have quite a resilient bounce back in terms of every business that goes under, a new one comes up. Now, I always like to caveat and say, like, this not to minimize the pain and suffering that goes into a business loss, right? That affects like families and customers and people are affected by every business that goes under. But for the economy at large, what we saw in 08, 09 is when businesses go under, by and large, there's another one that pops up to replace it. So that's encouraging news.
That is very encouraging news. I found that surprising as I was reading the paper. So I have always been a huge advocate for insurance careers because insurance is very recession proof. And we are seeing that right now, right? As we're recording this, no carrier has announced big layoffs. We just might survive this without major trauma. There will definitely be changes, but so I knew that carriers were very resilient, but I had no idea that in the overall economy, it's not the same businesses that come back, right? I found that very interesting in reading it, right? When you're talking about the number of construction businesses that existed before, and then after the number is very similar or higher, they're just not the same ones, right? Many of them go out of business, and then so right now, for example, many restaurants for sure will go out of business, right? They'll likely be replaced fairly quickly once the economy reopens and the demand is there by other entrepreneurs who didn't lose their shirt in this mess. So from my perspective as a commercial insurance company, or our listeners' perspective as a commercial insurance company, like, your restaurant program probably won't disappear, but you might lose a lot of market share if you've been sitting on this program for a long time and you haven't been growing it. Those focused on actually growing might take a lot of your market share over time, but the market will still be there for you to write this type of business. So that was the main thing I got out of like that piece of the research.
Yeah, I think there's a couple of things, so similar to you, Tony. I started my career at an insurance company in the teeth of the last recession, and the things that we saw at that time, one from a kind of on an underwriting side, is we saw loss ratios really start to sag relative to their prior performance, right? So I was working in workers' comp, and it's a longer tail line, so you saw a lot of claims stay open a lot longer, right? Because people didn't have jobs to go back to. You could infer a lot of easy parallels to this current situation. And the other thing, as we point out in the white paper, is there's because of increased churn, right? Because of increased replacement within the sector, it's reasonable to expect not that there won't be restaurants, right? Not that there won't be restaurants, but that the ones that the players that are in the current space will be under significant pressure to fight to survive, and the ones that do will see declines in their exposure basis. And then that there will also be a significant uptick in new entities that are replacing that, right? And so there's kind of strong internal demand within the American economy for those small businesses, right? So it's not like small businesses.
So here,
yeah, go ahead.
I spent 2 minutes trying to explain the those two words, basically. That's exactly what I should have said at the beginning, right? This is different from '08 in that it's not that the economy died, right? The demand is there. It's just waiting to be released.
Totally, right? And then, so the implication that we see for an insurance professional and an insurance organization in this place is, are you prepared to handle that churn from an efficiency vantage point, right? Are you prepared to be able to, one, manage your current book of business in a fashion that is cognizant of the fact that there will be a downturn for those who do survive? And are you prepared to handle the influx of upstart replacement companies that are going to invariably come in their place?
So I've got to say, you have set me up so nicely for an ad for my day job that I want to have to do the
Nice.
ad. So just so everybody knows, we didn't plan. I did not pay John for him to set me
But
up
you're
like
welcome
this,
to. You're welcome.
So my day job, which I don't mention too often, and I'm wearing the perfect shirt on everything. This is almost embarrassing how good this is. So I sell staffing services to the insurance industry, mostly to the carrier space. I work for the Jacobson Group, the oldest and largest executive search and staffing firm serving the insurance industry. And I happen to be on the side of the company that sells temporary staffing. So basically, I sell unicorns. I sell temporary insurance staff, any function, any level. So basically, carrier executives, if you're listening to this, they're right. You have to be ready for the influx. You should give me a call so
Nice.
that the MSA is ready. And when you all of a sudden need 50 commercial underwriters next week for the next 6 months, I can hook you up, whether it's 1 or 50, and any function, any level. So anyway, that's the ad right there. It happens to be what I do, what I do for a living. So thank you.
No, totally, and it's definitely.
I completely agree with and luckily, here's the good news. Again, Jacobson just did we do a survey, or not my department, but the company does a survey every 6 months to gauge what carriers think staffing is going to be like. How much are they looking to hire and what areas? And they did a special one for the current crisis. And what they found is the carriers are not currently downsizing. There's no layoffs. Some of them have frozen hiring for now. They're kind of holding their breath, but they're not. It doesn't appear that they're overcorrecting, right? So I think that's a good thing.
Yeah, we've probably seen more reductions in insurtechs. Like that's where I feel like I've seen, if you look at the list of insurtechs, they're making cutting. Because again, you raise enough capital for 12, 18 months. If it takes 6 months for a correction, that could be, 50% of your capital. So you have to make some cuts to potentially get through the hard time. So yeah, I mean, that's one of the nice things about working for a company that was, founded in 1887 or whatever. You have the stability.
Many of the carriers,
there's some downsides, but at the same time, the upside is stability, and they're not going to do massive layoffs right away.
So this is very interesting. And in fact, just today I was chatting with Brett Follner that we should record a podcast episode about that topic. That insurance and insurtech had begun starting to become the same thing, right? We're becoming the same network of people, right? Like lots of cross-pollination, lots of partnerships, etc. This might have interesting effects because the carriers are sitting on a lot of money to wait this out for a long time, right? The insurtechs, if venture capital gets scared, we're going to see a massive change in the insurtech space. So that's not a topic for today, but yeah, I really for all my friends in insurtech, I really hope that you're sitting in a situation where if you can't get funding for the next year and a half, you're not out of business.
Right.
Yeah, I mean, I think it's one of those things where, and I know it's not the topic as you mentioned for today, but there's totally one of those things where you listen to about the opportunity to listen to some of the internal messaging at some of the leading carriers around, and the messaging is this time actually constitutes an opportunity for them to grow in that space, right? Because if what we're saying is true, and we think there's ample historical evidence that it is, that there will be a resurgence and a bounce back in an area that is traditionally very like expensive for carriers to recover with, right? A lot of processing costs associated with it. Then right now, that dynamic you're mentioning of a lot of really high quality insurtechs out there with a lot of talent, resources, smarts, innovation, that constitutes an opportunity for carriers who, as you're saying, are kind of a de facto investment arm themselves into some of the into some innovative opportunities. I
can't make up my mind. I didn't start thinking about it until today, but I can't make up my mind on which way it'll go, because on one hand, the carriers, de facto investment arm, right? They're sitting on a ton of cash. On the other hand, they're super conservative, right? Super, and even the ones that have created specifically venture arms to compete for to fund and benefit from some of that insurtech talent. Even some of those, and it's not, I haven't heard it from any of them yet, but even some of those might get kind of a red, yellow or a red light from the CEOs,
the higher ups.
Yeah, you're right.
Basically, going like.
Yeah, I mean, I had a conversation with a carrier about like some of this topic. Like you should be ready for new restaurants. You should be ready for new businesses. And their immediate response was we don't write new ventures. That's not. You have to have been in business.
Oh my God, I didn't even think about that while reading your paper. Okay,
yeah.
Well, it's right here. Dear commercial lines chief underwriting officers and other members of the leadership in commercial insurance carriers, this is a massive opportunity that you will completely miss if you are not willing to write new businesses.
Right.
And if you're not willing to write new businesses, what we're going to end up with is with companies like Founders Shield and what is the name of Travis Hedge new company? I can't think of it right now. But anyway, they're a startup insurer company. I'm going to actually look them up real quick because maybe I'll send them a ton of business. So yes, if you traditionally are not comfortable with writing brand new restaurants, brand new hotels, brand new airlines, whatever it happens to be, this is the time to get comfortable at it, because while basically the long and the short, as I understood it, I'm not a numbers person, right? So tell me if I'm wrong, but the long and the short of what I got from the white paper is basically there will be roughly the same number of restaurants and hotels, et cetera, on the back end. Many of them will be new ones, right? So if all of a sudden, right, if you write a lot of restaurants and 60% of your clients go out of business, get replaced by other restaurants in the next 12 months after they go out of business, and you're not comfortable writing brand new restaurants,
right?
Bouch is Travis Hedge company. So you're going to be sending a lot of business to the Founder Shields, the Vouch, the whatever other small new carriers out there are specifically comfortable and good at writing startups.
Yeah, and I mean, it's one of those things where, you think about like how simple could a minor change, like revising your underwriting guidelines to say like, hey, we don't write new restaurants, to, hey, we don't write people who have never owned a restaurant before, because there's a lot of people who will presumably like be starting a new restaurant, at least based off my prior life. What I've seen is the people who know how to start restaurants, and if they lose their old one, they're still very employable as a restaurateur, right?
This is the beauty of having actual insurance people, right? Like former underwriter and an actuary or a former actuary. You're absolutely right, and the reality is that at most commercial carriers, and I've been a commercial underwriter twice. At most commercial carriers, you can make the exception, but you have to be an experienced enough underwriter to know to make the exception, to be able to sell it to your management to get the sign off to make the exception.
Right.
So it's And at the same time, we are, a lot of people have retired in the last few years, what I've been talking about for years. So a lot of your experienced underwriters who knew how to make that case for, hey, we should write it because, right, the owner has done this 3 times successfully, et cetera. Like, that guy likely has retired, and all your young new underwriters don't have the experience to know when to deviate from the rules. So it might not even be you have to rewrite the rules. It might just be you have to teach your people that it makes sense to deviate. It could be that simple. It could be that simple for a lot of carriers out there. It's fascinating.
That's a good point.
So I found it very interesting in the paper that and I quote, an unlikely benefit of the flu, the Spanish flu in 1918, was an increase in demand for life insurance. And I had read the same thing at some point about the Chicago fire being one of the big reasons that fire, or what is now property insurance, became popular in the States and became common and then compulsory. So yeah, crises generally lead to correct insurance coverage. So how do you think this time, how might the current crisis lead to insurance growing significantly?
Yeah, I think you'll certainly see a lot more people reading their policy to determine.
Not convinced.
So Tony, you'll see the number go from 1% to 2%. So
massive growth.
A significant
100% growth in the number of people that read their policy.
In case you're watching you're listening to this on the audio version instead of the video version, the girly laugh is mine. I don't want anybody to think that Lance or John has a girly laugh. Totally me.
So I do think you'll see more interest in all forms of coverage. So life insurance increased. I've heard anecdotally from friends of mine in the life insurance industry that applications are up. So I think we're seeing increases now, and it just, everyone's going to be thinking about, what kind of cover do they have? So I think in general, you'll see some increases. I mean, you may see some disgruntled, switching as well. Like, so, for instance, I've been following like the Paycheck Protection Program that the government rolled out. I've known a lot of people that were with Wells Fargo and didn't get their loan, weren't able to get their loan processed. And I've heard those people say, I'm switching banks. Like, I'm no longer at Wells Fargo. What's it worth? Same thing might happen on commercial insurance. So if my business interruption claim is not paid, I'm going to switch.
I'm going to say, and this is not a banking podcast, but and I'm not a banking guy, but I'm a former Wells Fargo customer and the funny thing is I was a Wells Fargo customer for a long time and ended up moving. They never did me wrong, right? I ended up moving for other reasons. Basically, I moved to Ohio. They didn't have any branches, and every twice a year I needed to deposit actual cash, right? So I changed banks, but it's just funny that you specifically say Wells Fargo because they've had so many troubles over the last few years. So what I'm curious is, like, if this is the thing that finally gets you to give up Wells Fargo, like, how much have you been abused over the years?
Right.
How many fake accounts did you have?
Right. That's exactly right.
I'll have to have Carly check that our insurance is up to date in case Wells Fargo doesn't like that comment. I'm sorry.
Yeah, no, I think you'll have some
little
people
color commentary.
Some folks will switch their insurance because their BI claim, even if their BI claim wasn't, had no foundation. There was no property damage, it's just like, or, pandemics were specifically
people are
excluded.
irrational. Yeah, people don't understand insurance.
And so I'm going to switch to this other carrier because, so-and-so's done me wrong. And so now I'm going to switch. So I think that's one thing we may see, little churn as a result of that too, of unhappy with my claim, not being paid.
Yeah, I mean, I think you can look at other, past crises like 9/11 and see how, TRIA came out of that and how there are like structural shifts. The other interesting thing that I think about, at least within my particular backstory, is because so much of insurance is mediated and adjudicated at a state level. there will be some interesting variability that may happen across state lines. Like, are there certain claims that become compensable in certain markets, and does that introduce weird distortions?
So,
Right.
For our younger listeners or listeners who are newer to insurance, insurance is completely regulated state by state. So it is the NAIC does a great job. That's the National Association of Insurance Commissioners does a great job of kind of putting together model laws and trying to help the states adopt somewhat uniform regulation. The reality is 50 states, 51 jurisdictions when you count DC, 51 different ways to regulate insurance. And yeah, we're seeing it right now, right? The New Jersey was the first to start discussing legislation to force carriers to pay for business income losses. By the way, self-ad here, we did a podcast a couple weeks ago. Go back, I don't know, episode like 4 ago, specifically about how we should end up with a pandemic risk insurance, very similar to TRIA. And how necessary that's going to be. So go back and listen to that episode, please, if that's of interest. Okay, so yeah, that makes sense. But by the way, and this might be a complete jump, because this is me and I didn't take my ADD meds today.
Totally.
And I'm still drinking coffee at 4:35 p.m. So I found this very interesting. 90% back in the Spanish influenza, which is the closest thing we have, even though the economy was so different at that time. 90% of the fatalities were under 40. So basically, working age, like the heart of the bulk of working age. While coronavirus, it hits the older population and the at risk, the less healthy population. And why? And how? I don't know if you addressed it in the paper. Maybe I missed it. But how is the effect likely to be different this time compared to that time because of the different age group that it hits?
Yeah, I mean, I'll start this out by saying I'm not a doctor or epidemiologist, but from our research, the Spanish flu influenza particularly attacked people with really healthy immune systems. So it's almost like the more healthy your immune system was, the healthier you were, the harder the virus attacked.
That is
so
so
you had
weird.
this really weird thing where, it was just devastating for people who were in the prime of their working life. So I think in many regards that would have a bigger impact on the economy at the time than this would have, having the impact of affecting older people right now. So I don't pretend to know enough about the difference in the flu strains to know why, but that's what happened.
One thing that I really liked about the white paper, and if you're listening to this and you're in the leadership of an insurance company, this is the main reason, or the big reason you should go and actually download the white paper. I'll link it in the notes rather than just our description of it. You guys did a fantastic job. I would have never thought of looking at it this way. So basically, 1919 is the closest thing we have, but SARS was much more modern, right? It happened in a world much more similar to our world today, 2003, but it wasn't a worldwide pandemic, right? So you guys talk about the effect of SARS on Hong Kong,
right?
Because it hit Hong Kong the way that this is hitting the whole world now, right? So that I thought that was an absolutely brilliant way to look at it, and so. What are kind of the key takeaways that the listeners, if a listener's too lazy or too busy, let's say too busy to actually go and read the white paper, what is the biggest thing that you guys learned from looking at the Hong Kong numbers?
Oh, I'll give my takeaways on that. The things to see in the Hong Kong data is that the recovery was V-shaped rather than U-shaped. There was a sharp decline and then a sharp bounce back. Probably the caveat that you alluded to, Tony, is that was a fairly self-contained decline. And so our belief is that one of the reasons why that might possibly have been such a quick recovery is there was a supporting infrastructure around that blighted economy with which to quickly recover, right? Like
Yeah,
the rest of the world was still largely
mhm.
intact, right?
Yeah.
And so infrastructural product supply lines, et cetera, we're not depleted or devastated like that. It's a very different scenario right now, wherein we have a massive network effect ramifications coming out of this particular crisis. So while we can look to SARS and be like, hey, maybe this is a source of optimism, it's potentially important to call out that caveat.
So basically, like Lance earlier said, the good news is right now John is this is bad news. Yeah.
Yeah, I hate to tell you.
You get to play the bad cop.
Yeah,
so the bad news is that because it's the whole world this time.
I think that's just one point of distinction, that if you were looking to SARS to see some source of encouragement, and there is reason for encouragement in this particular context, that's one important distinction that just needs to be drawn.
Yeah, and SARS was so much smaller too. I mean, there's 8,000 total infections, limited to one geographic region. We're so many orders of magnitude beyond that now. That it's going to be really different. I mean, one thing that did happen with SARS that I'd love to happen with coronavirus is SARS just kind of died out in terms of the virus's ability to infect people. So they went from the feeling we have today around there being this pandemic that's going to keep going on and what's going to happen, to just no new cases. So I will say, if something like that were to happen, then certainly we would see a pretty quick recovery. Now, from everything I've seen, there's no evidence that that's going to happen. So we probably are more in for a U-shaped recovery versus a quick V. But that's SARS is just so much smaller than what we're seeing right now.
Yeah, it's so hard to compare. SARS infected with like 10,000 people total, and we're looking at 2.5 million worldwide, right. Something like I feel like Dr. Evil saying that, right? Like it's so ridiculous. It's so sad. Like we always have to remember that, right? Like this are people's lives, and even the businesses that won't return, right? Those were people's employers and people's livelihoods, and people had invested their entire lives into making those things. I was in New York City recently. Before the pandemic, I was in New York City in January, giving my mom and my sister, who had never been, a tour, and we really did a great tour of the city. And so thinking thinking now, they're at the heart of the pandemic right now, and like every bodega, every restaurant, every outside of the museums, which are state owned, are big enough to survive. Like every cool thing we've stopped at, no clue if it'll be there, or what form it'll be there. It's crazy to think of. Yes. If you insure a lot of that, right? If you're the sales manager that or the agency that sold in that area, your book's gonna look it can be saved because things will open. There will be other restaurants, but you'll have to put your nose to a grindstone to find them, and then you'll have to find the carrier. If you're the carrier, you'll have to get comfortable with writing the new business. I have a highlight here in my copy. The bad news is that if you believe the pandemic will be 3 times as destructive as the Great Recession, then that would equate to an overall payroll reduction of 24%. Good news is that based on what we can gather from the 08-09 data, there will be a recovery. Okay, so 3 times as destructive as the Great Recession, as 08-09. That blew my mind, right? Like I never thought in the last couple of weeks, and it's last weeks I've really kind of been getting it, that this is the new reality for a while.
Right.
And I truly believe that this is a era-changing event, right? That there will be the world before coronavirus, the world after coronavirus. Kind of like we always talk about the pre-war and the post-war world, or the pre-9/11, post-9/11. It'll be the post-coronavirus world, but 3 times as bad as a Great Recession. That blows my mind. Like, where did that number even come from? Why 3 times?
Yeah, I think, one is like, we don't know how bad it is relative. So part of it is like, let's think about how bad was the Great Recession in terms of job loss, payroll loss, that sort of thing. And then let's estimate, do we think it's 2 times, 3 times, 10 times? Like, where do you think it is? So that was just a technique we use to say, it feels like it's definitely worse. It might not be 10 times as worse, based on what we're seeing from, potentially long-term unemployment, and there's a big spike right now. And so, the number we came up with was kind of 3x. If you believe it's 3x, here's the impact. And for, particularly if you're in workers' comp space, payroll is a very key factor to how much premium you're going to get. And so if payrolls go down a lot, premiums are going to go down a lot. So that was just our way of kind of getting to a number. I have no clue if it's going to be 3 times as bad.
You were not predicting at all. You were example. Okay.
No, I mean, I think one thing that's interesting, Tony, is like it's just so hard to predict, right? I mean, one of the things we found in the white paper,
especially about the future.
Yeah, the future, right?
Yogi Berra that said that. Yeah. Anyway,
exactly. I mean, there were several studies done on what would happen to the economy if a pandemic hit, and what I found to be really interesting was that many of those studies were pretty much spot on in terms of loss of life, the number of people that would get sick. All those things were like relatively close, but no one came anywhere close to estimating the financial impact. Like one of the most starkest estimates that we saw was $250 billion of economic loss. And so that's what they said, 2 million people die, and that we get $250 billion of loss. But what's happened is, like, we haven't had anywhere close to 2 million people die in the US, thankfully, but we have, maybe 10x as much loss as $250 billion. So
that is so, yeah, like if you had to, and I'm not an economist by any stretch, but if you had told me a year ago that in the first quarter of 2020, we would get 16 million new unemployment claims.
Right.
Take a wild guess what led to that. My God, like I would have been like, major nuclear bombs dropped on New York City, LA, San Francisco, Chicago, and Houston. Right. And maybe like that is incredible without any damage to the physical capital, right? Like the factories are still there, the restaurants are still there, the offices are still there, everything's still there, the movie theaters are still there. They're just closed.
Right.
It is. We truly are living through a historically insane time, and I am so thankful that I am a partner to the carriers, not a leader trying to run a department at a P&L in a carrier or in any other business right now. Just, yeah, it really is absolutely crazy. When I go quiet for a little bit, I'm literally like pulling my screen down, looking at my next highlight. So feel free to fill in with whatever information is interesting from your side.
Just one last thing on that number of the, is it 3x versus, you made that point about 16 million in the last month or so. Peak to trough, the Great Recession, the BLS estimates that about 8 million jobs were lost, right, over the course of 6 quarters. And we had that happen in 1 month. So whatever the long-term implications, we're talking about a highly compressed, acute set of economic damage that the long-term outcome of which remains to be seen. I mean, to your point, encouragingly, much of the physical infrastructure is virtually entirely intact, so that would bode well for a recovery. So it'll certainly be intriguing to see the months ahead.
Well, and the demand for the most part will be there, right? Like, okay, so let's say that magically Fauci announces tomorrow that we have a vaccine. We know we won't, right? But let's say that they announce tomorrow or next week that we have treatment. We don't have a vaccine, but X drug that we've been testing appears to work. If you get it, we'll save you, right? The death rate is going to be much smaller. Like nobody's going to end up in a ventilator. We have proper treatment, whatever the word is. We have therapeutics, I believe the word is, right? And we got incredibly lucky, right? Like it's probably not going to happen. The demand would probably come back for most things. Now, those unemployed people are going to take a little bit, right? It would still take a few months to kind of for them to either get called back into their old jobs or find new jobs. But the demand would be there. So that's a really weird thing this time is right. we're in limbo. The demand is because when I say it's very different from 08, I remember 08. I remember friends who worked in finance and having conversations and right, they were my age, had graduated from college 3 or 4 years before, were working in finance. Boom, everything goes to shit. Everything, right? Everybody gets downsized. All of a sudden, like there's just no demand for their skill set, and there's hundreds of thousands of other people with their same experience, same background, same degrees, and no jobs, right? That takes a long time to absorb for the economy, and thus we had lots of long-term unemployment.
Right.
We don't have that right now, right? All the people, all those restaurant servers and hotel people, and my brother-in-law who's a pilot, like their skill set's still in demand. It's just the demand is being held down right now.
Right.
So
totally,
it's so hard to plan if you're a leader right now for this world. I found it very, very interesting that you talked about how 21% in 0809, 21% of all construction companies failed in 09, but those that survived actually had a slight increase in wages based on work comp data. So that is very, very interesting. Are you expecting kind of the same here, or are you? I would even say, are you expecting even like a big bounce in right? Your restaurants, for example, that do survive, have a big bounce because a lot of the competition's gone out of business.
Yeah, that certainly could be the case. We certainly could see if you're fortunate enough to be able to make it through, then you do see a bounce and an increase in overall wages.
So that would be really good for the work comp carriers that have that. Okay. So then you guys define a new term in the field of pandemic economics, the recovery rate. Basically, the number of new businesses in a given category created divided by the number that failed. So what was the idea of this of this particular new measure that you've now introduced to the lexicon?
Yeah, the idea is essentially that what we're up to is given a particular segment, we want to see at a segment level the resilience of that particular industry, and is that industry going to be the sort of thing where a massive secular change in the economy introduces a more prolonged blight? Or is it one of those things where there's robust enough demand that it's the whole thing of you take your foot out of a bucket of water and the hole doesn't last too long, right? Like if you take a particular company out of the economic system, is there going to be another one that pops up in its place? And so it's essentially a measure of the resiliency of a sector as a whole.
Okay,
and
gotcha.
you can see that if there are more fixed costs or barriers to entry, like starting a construction business, right? There's a lot of fixed cost to start a new construction business. It's harder to just jump right in and say, oh, there's an opportunity in the market. I'm gonna start this big commercial construction business. That's harder versus starting a restaurant. And I think we may actually see some fundamental shifts throughout this change. I mean, there could be restaurants could look different, hotels could look different. I mean, there could be some small changes. So I think overall, there's eventually a bounce back and recovery. But there certainly could be losers and it's different than what happened in 08 or 09.
I love that you're giving me, or you're giving commercial insurance carriers a really nice, a great roadmap a great roadmap on, okay, right, if I run a commercial insurance carrier or the commercial department, right, first thing I want to know tomorrow from my data people or my business intelligence people is what are the main, and I've already always known this probably from my appetite, what are the main business types that I have? And number two thing I want to know, and I might have to bring a consultant or somebody in to figure this out, is, okay, so for those businesses, what is the best estimate we can come up with for the recovery rate, for how the payrolls might increase when the economy reopens? I think that there's a lot to, like this has given me a lot to think about, even though I don't run a commercial lines company or department. So I think that you guys have done really a great service to the industry. I'm halfway surprised that you're giving it away. I mean, I understand that ultimately white papers, are meant to get your name out there, and it'll definitely do that. But
thanks, Tony.
I think that it's very well made. The rest of the paper is kind of the proposed solutions. We don't have time to dig into them, and I think that those it does make sense for people to just download the paper and read them. Is there anything else when it comes to the analysis? Anything else that I didn't ask you about that you thought was really interesting or that is crucial for the listeners to know?
Yeah, I'll just give some takeaways that really struck me in putting this together. One is that carriers were made for moments like this. Like your brand ethos has never been more clear and straightforward than it is at this particular moment, right? You were built for a time like this, and this is as much as it is a challenge financially and kind of existentially. This creates significant opportunities for all people who are associated with the insurance industry to actually like really understand. I mean, it's really hard, having been in this place, it's really hard to communicate the value of an insurance policy until you need one, right? And now we're in this place where people have a manifest understanding of why insurance is there and why it exists, right? That's an opportunity. The other thing I'd say is management of expenses. The losses are going to be what the losses are going to be, and so creating opportunities where efficiencies can be gained is really the way in which we believe that, and part of our motivation in terms of the work that we're doing, in our day jobs, is that the way that carriers win is through management of the way that carriers win, the way that MGAs and brokers win is through the management of their expenses. And go ahead.
And to the listeners, please don't do it by crapping on your people.
For sure.
or your clients, right?
For sure.
There's.
Well, you made the great point earlier, Tony, about how the people in this are the greatest resource. The people with the underwriting expertise in your building, those are the people that give you the ability, who have seen this before.
And then the claims.
For people. Sure. Not excluding the claim. Just underwriting background, like sharks, jets sort of moment.
No, I'm team underwriting too, but yeah, like ultimately, like your claim people have to deliver your promise.
Absolutely.
And they can only do that if they have the right tools, if they're taking care of themselves.
Absolutely.
It's just when we were talking about efficiencies and costs, the MBA in me remembers the last decade and a half worth of disappointments where outside of insurance, especially when the word efficiency comes up, it usually means let's cut jobs, right?
For sure.
The last thing we need here, we need we need efficiency in the hand of hand in hand with effectiveness. And yes. In our industry, yes, we need better systems and better processes. But we need experienced people with empathy and with the right education and who really understand the importance of what we do.
Absolutely.
I think ultimately what you're saying, I really love the message that ultimately this is the time that insurance is built for, right? We always brag that right, the Chubb thing, like who insures you doesn't matter until it does.
Right.
And I always talk about how psychologically insurance is a really hard product because if everything goes right, you don't get anything. You don't get anything tangible out of it, right? Only the people that had a claim and it went well are happy with you at the end of the year. The rest are wondering why they threw the money away, quote unquote. But the reality is that is the whole idea. Like the whole business is. Hopefully you don't have a claim that is right, but when you do, we'll take care of you. And you're right, that right now is the time, and it's going to be really tricky, especially I think I think that we will shine in work comp. So if you're a work comp carrier, your claim, right, the losses will be what they are, the claims are what they are, but this is your time to shine. If you're a BI carrier, which is just about every commercial carrier, right? This is going to be hard because this stuff's probably not covered, and the customer's not going to understand it, and you can't cover it, right? It would literally put you out of business if you did. Right. It's not like you can courtesy cover it.
Right.
It's like the numbers from PCI published in the Insurance Journal just blew me away. It would bankrupt the industry in a matter of 2 months.
Right, and a lot of the carriers too aren't. I mean, you think about the Hartford, Liberty Mutual, you have the big guys, but there's like thousands of insurance companies that are, you know, it's
literally
like a couple hundred people in an office somewhere in the Midwest, right?
Oh,
you know,
there are carriers out there that are like 5 people
right.
that insure 2 counties in Iowa, right? There's hundreds of those.
So yeah, those are the people that are going under.
That is sad. So we're kind of out of time here, but this has been honestly one of my favorite discussions ever on professional risk. Part of it because we've been talking actual insurance, not just insurtech, like that guy that ran the podcast for a while, whose name shall not be named. We still love you, Nick. It's okay. We still love you. Even if you were too insurtech focused. And also because I actually understood everything we talked about today. A lot of times with some of the insurtechs, like I'm like, yeah, this is way technical for me. So I want to transition real quick, John, especially. You have an interesting, and I warned you before that I would. So let me put a pause here. If you are the leader of a commercial insurance company, you can dial off now. From here, the rest of the chat is really for the young crowd. But career-wise, which is I'm really passionate about insurance career-wise, John, you've had an interesting career because you started in underwriting and then you went to the analytics side, and now you're the technology half of an insurtech. How did that happen? And especially, how did that happen? Let's start there. How did that happen?
Yeah, I mean, a lot of conning and swindling people probably. No,
and that's the show for today.
Yeah.
That's your career advice.
And insurance technology. There you go. I mean, so my background in underwriting, I ended up in insurance the way that probably a lot of people end up in insurance is you kind of crash land into it. I mean, unless you're happen to be, I don't know, like an actuary or something.
The traditional way. Yeah,
and I'm not known to associate with those people. But yeah, I mean, like probably a lot of the folks who are listening.
So yeah, you went to college for something else, not RMI, like just like the rest of us. And then you need a job. You land as a personal lines underwriter somewhere.
Yeah, and then the opportunity within the I happen to know the first thing about Excel, and the things that I know about Excel, I YouTubed, and that opened up the opportunity to get on as a data analyst, and then I got moved to kind of progressively more and more antisocial parts of the organization. Why don't you talk to even fewer people was essentially the professional mandate that I was given. And so
you drew the line just before actuarial.
Yeah, that's right. Yeah, that's right. So I mean, I basically moved from being a data analyst to more of a data engineer type into more of a data science role, and then had the opportunity several years back to be the first employee at a digital MGA here in Colorado called Insurer, and really got the opportunity there to kind of combine both the underwriting and the background.
I want to pause you for a second. So if I understood correctly, several things played into it. You already had the math aptitude to the point that, and the curiosity to the point that you could just teach yourself a fairly advanced level of Excel on YouTube, right? Which I've had like expensive Excel classes and I'm still like just halfway at Excel and really bad at math, right? So there was definitely aptitude there to begin with.
Sure.
But also, I'm impressed by the carrier that you were at, and I won't name them unless you name them. But great job, them recognizing that you wanted more than just underwriting and giving you those opportunities. I see lots of people where that's where right. I meet lots of people who are in one job in the carrier and they want to get out, and the carrier doesn't recognize, hey, with your skill set and interests, you'd be a great match over here. So kudos to them for doing that.
No, I give them a shout out. Yeah. So I mean, Pinnacle Assurance, the state fund here in Colorado, very forward thinking and very, very like opportunistic, both in terms of. Go ahead.
No wonder you get work comp because you come from a work comp carrier, like a real like that's a work comp specialist, right?
For sure, they're monoline.
Okay. Okay. That explains it.
Yeah, the other thing I would say though, just to someone who's in the world of, hey, I'm on the business side of an insurance experience and I'm wanting to transition to more of a technical role, is don't discount the degree to which the subject matter expertise that you have in question can be an asset. Because like in many ways, like it's comparatively easy to Google, how do I do this in Python? It's virtually impossible to understand unless you've been like exposed trial by fire to the Byzantine rules and oddities of how a carrier thinks and how insurance works. I mean, I would say make sure that you don't discount the subject matter assets that you already have, and use that as a. So I actually my first job was I was a middle school teacher, and and like there's this notion in teaching of scaffolding, that you use a concept and you basically like conceptual framework, right?
Yeah. Sorry, I've got to interrupt
there.
I had no idea about that scaffolding idea. What my best friend, well, not my best, one of my very good friends in high school, Dan Solera. We remain friends to this day. Dan always said through school that basically every year you find out, and he's a very good student. I'm a really bad student. So he's like, every year I find out that they lied to me last year, right? Right, that what they told me last year and I learned and I took as canon.
Yeah.
Turns out it's not quite the real truth. Is just as deep as we could get at that age.
That's
anyway,
right. Scaffolding.
So it's like the other. Okay, so now I know why they were doing that. Anyway,
totally scaffolding, right? And so the idea is use the scaffolding you have, right? So use the things you do know to build up the things you don't, right? Like and in the case of many insurance professionals, you have a robust scaffolding framework to help lay alongside those technical things, and so. Those are I don't know if that answers the question that you had.
No, that is fantastic. That is absolutely fantastic. We're way over time, so my apologies to you guys. Hopefully you're not late to any meeting. And listeners, if you're still listening, it's because it was a good conversation. So, but we're way over time. But yeah, I hear from lots of young insurance professionals that they're interested in digging into more analytical stuff. So it's great to hear this. Also, again, you set me up with a great sales point, even though I told the actual leaders to move on because we were going to chat careers now. But I'm always selling the idea to carriers that, hey, if you need an analytics person, cool. If you need an IT person, a developer, something cool, the first question I'm going to ask is, how important is the insurance experience, right? If you need a SQL coder and you just need them to be great at SQL, I'm probably not the best option for you. But if you need a SQL coder who has done insurance,
Exactly.
that's what we do, right? So that you don't have to spend the first 6 months explaining to them what a loss ratio is, right?
Exactly.
That's exactly what I do in my day job, is provide people like that. So thank you for setting me up again.
Totally.
And the last thing really is, and this, I might have to have you come back for a whole episode on this. So there's a lot of talk about the future of the future underwriter, the future insurance professional, and a lot of the research, I think mostly by EY, says that the underwriter of the future is really going to have to be really good at the analytics piece. And it scares the crap out of me because I can't do math, right? My brain doesn't work. I'm a sales guy. My brain doesn't work like that. I tried many times. I failed Calc 1 5 times and eventually just changed majors. And that is why I did not graduate in computer science. That's the real story. I told it before on the podcast and in the book, actually. And that's why I'm in insurance today. But so I landed in insurance, and little by little, I'm like, crap, like this is also becoming a heavy like analytics area. So you are a perfect example of like the future underwriter that everybody's asking for, right? Give me the guy who gets insurance but is great at the technical piece, at not the technical insurance piece, at that, but can read numbers, can get insights from the numbers, can do the analytics. So awesome. Thank you so much for coming on the show. By the way, if you've been listening to this on the audio version, John speaks like a professor. So you're imagining like a 55-year-old with a beard. He's got to be like 35, like close to my age. So I'm 37, and both Lance and him look like they're in their 30s. So anyway, it won't take you a lifetime to get to that point. You just look at his LinkedIn profile and kind of follow his path. Thank you both for coming. Lance, hopefully you didn't feel ignored as I really had a lot of fun figuring out John's stories, since it's a little different than what I normally get.
A little screwball.
No, it's exciting. I just hope you don't place him as an underwriter in one of your client companies now.
And my guess is he'd be too expensive to be an underwriter now with the analytics experience.
That's right.
But they're always asking us for analytics leaders that get insurance. So
That's right.
You might want to keep him from sending me his resume.
If Juniper Labs doesn't work out, then
there you go. There you go. No, thank you guys, and
Thanks,
to the
Tony.
listeners. Do go and download the white paper. Really, it's so good that I'm kind of shocked that you guys just gave it away. You're doing a great service to the industry. Thank you very much. It'll come back. It'll pay off. Like things like this always pay off in the long term. So thank you so much for chatting today. Sorry that it went a little long. Thank you.
Yeah, thanks, Tony.